All right, ready to dive in. Today, we're looking at specialty chemicals, specifically AMI Organics.
AMI Organics.
Yeah, ever heard of them?
Um, Legally.
Okay, well, get this. They've created over 520 products, and they work with over 500 clients. That's huge.
Wow, that's a lot.
It is. We're going to break down their Q2 fiscal year 2025 financials. See what we can learn. You ready?
Yeah, let's do it. Let's dive in.
Okay. Now, they're not dealing with just any old chemicals, right? This is specialized stuff.
Right, exactly. Think advanced pharmaceutical ingredients.
Pharmaceutical ingredients, okay.
APIs, they're called for short. ATIs.
Uh-huh.
And they're also working with materials for things like agrochemicals and fine chemicals.
Okay, so we're not talking about the stuff I have under my kitchen sink. This is pretty high level.
Definitely not. Not the baking soda and vinegar.
No, no,
This is high-level chemistry.
This is the big leagues. But what does that mean for AMI Organics, like big picture?
Well, it puts them in a really interesting niche. They're essential in the supply chains for pharmaceuticals, agriculture, all sorts of things.
Essential.
Yeah, we're talking about the building blocks for brand new drugs, pesticides that are more efficient, the kind of innovations that have a global impact.
Okay, so they're like, what, the silent heroes of these industries?
Kind of, yeah. Unsung heroes, maybe.
But heroes have to make money too, right?
Exactly. They got to pay the bills.
You mentioned some key metrics for Q2. You wanted to look at their revenue, their EBITDA, those margins. What was the other stuff? PADI, trade receivables, and free cash flow.
That's right. Yeah. A lot to unpack there.
Yeah, there is a lot to unpack. So let's just start at the top with revenue. What's going on there?
Yeah, good place to start. Their revenue, they reported a consolidated revenue of 172 crore rupees.
172 crore.
172 crore in Q2 of fiscal year 25.
Okay, hold on. That's a big jump from Q1. That was what, 154 crore?
That's right, yeah.
What's driving that growth? They find some new blockbuster drug ingredient. Did they, like, corner the pesticide market or something?
Not quite that dramatic.
Okay.
But there are a few things that could be at play here. New product launches are always a possibility.
Okay.
Or maybe they're just seeing more demand in the markets that they're already in.
Makes sense.
Expanding into new territories is another thing they might be doing. We'd really have to dig into their presentations to investors to figure out the specifics.
Oh, all right. So that's something for our listeners to kind of check out if they want that inside scoop.
Exactly.
But it's a strong signal either way.
It's definitely a strong signal.
Okay, well, let's move on to EBITDA then. What's the story there?
Yeah, EBITDA came in at 25 crore for Q2, which is up from 34 crore in Q1.
Okay, that's up. But there's a however.
Their EBITDA margin actually dipped from 22% to 14%.
Wait, so the revenue and the EBITDA both went up, but the margin shrank. It's like baking a bigger cake and then getting a smaller slice.
Yeah, that's a good way to put it.
What's happening there?
Could be a sign that their profitability is under some pressure. It's pretty common for rising input costs to be a culprit, you know?
Input costs, like what?
Things like the raw materials they need, or maybe energy costs are going up. Could also be that their operating expenses are higher.
Makes sense.
We don't have a ton of detail from the financials, so it's hard to say for sure, but it's definitely worth noting.
Worth noting. Okay, so maybe a yellow flag there. Let's talk PT, profit after tax.
Yeah, PT took a swing, landing at negative 17 crore for Q2.
Negative.
Compared to positive 22 crore in Q1.
Whoa, negative territory. That's a big shift. Should we be worried? Are alarm bells going off?
Not necessarily. A negative PT for just one quarter doesn't mean the company is doomed or anything.
Right.
It just means that their expenses were more than their revenues during that time. There could be some one-time things that are kind of skewing the numbers, like a big investment they made or maybe a write-off. Again, we'd need to look closer at the reports to really get the full context.
It's like judging a movie based on one scene, right? You're going to see the whole thing.
Exactly.
Okay, well, you mentioned trade receivables. Why is that an important metric?
Yeah, that's a good one. Trade receivables, that tells us about the money that AMI Organics is owed by its customers.
Okay, so it's like outstanding invoices.
Yeah, exactly. Basically a measure of how quickly they're collecting on their sales.
So is that a good thing or a bad thing, like if it's a long time?
A longer collection period, yeah, that can tie up their cash.
Oh.
It could even signal some problems.
Oh, okay. So are they getting paid promptly, or are those invoices piling up?
If we look at their debtor days, it seems like they're doing all right.
Debtor days. What's that?
It was 105 days in Q2 fiscal year 25, which is actually better than the last quarter.
Okay. So shorter is better in this case.
Yeah, shorter is definitely better. Means they're collecting payments more efficiently, which is good. Keeps the cash flowing, keeps the business running smoothly.
Keeps the lights on. All right, last item on the list. Free cash flow or FCF? I always get a little lost with this one.
Yeah, it can be a little tricky. Basically, FCF, that's the cash the company has left over after covering their operating expenses and any capital expenditures they've made. It's money they can use to invest in growth, maybe pay dividends, reduce their debt.
So it's like their fun money.
Kinda, yeah. Money for the exciting stuff.
Okay. So what does their free cash flow look like?
So the information we have doesn't actually break down the free cash flow on a quarterly basis.
Okay, bummer.
But we can look at the annual figures to get some idea.
Okay, what do those annual figures look like then?
So their net cash flow was -1 crore for the full fiscal year 2023.
Negative.
But projections show it's swinging to a positive 125 crore for fiscal year 24.
Wow, that's quite a turnaround. Negative to that much positive. What's the takeaway there?
Well, it suggests that while AMI Organics might have had some cash flow challenges recently, they seem to be on track for some pretty significant improvement. But we'll have to wait and see if those projections actually pan out, of course.
Right, always good to watch the crystal ball and see what happens.
Always.
Okay, so we've covered a lot of ground with those core metrics. Revenue, EBITDA, PAT, even tackled those tricky receivables and the cash flow thing. What's next? What else are we looking at?
Well, now we're going to shift gears a little bit and delve into some financial ratios. We're going to be exploring things like the price-to-earnings ratio, debt-to-equity ratio, and we'll look at the relationship between profit after tax and cash flow from operations.
Ooh, so we're going to get even more into the nitty-gritty with the numbers.
We're going deep.
I'm ready if you are.
Let's dive in. Okay, so let's start with the price-to-earnings ratio, or as the cool kids call it, the PE ratio.
PE ratio.
Got it. Emuranix, they're currently sitting at a PE of 92.
92. That seems really high.
It's definitely high, especially compared to, the market average.
Okay.
So a high PE ratio, it can be a sign that investors are feeling really optimistic about the company's future earnings growth.
So they're like betting on them.
They're basically betting that AMI Organics is going to outperform expectations. Yeah.
Okay. So it's a vote of confidence, but it also maybe means the stock price is a little high.
Yeah, that's a good way to put it. It's a bit of a balancing act, right?
Right.
If AMI Organics actually meets those expectations and delivers some really great growth, then their stock could keep going up.
Okay.
But if they kind of stumble, then that high PE ratio, it could make the stock a little more likely to drop.
High expectations, high stakes.
Exactly.
Okay. Well, what about their debt-to-equity ratio? What does that tell us?
All right, so debt-to-equity ratio, it's basically telling us how much debt a company is using to finance its operations.
Okay.
A lower ratio, that generally means they're relying more on their own funds and less on borrowed money.
Makes sense.
And you know what?
What?
One of the things that's been highlighted about AMI Organics is that they're pretty much debt-free.
Debt-free. Wow. That's impressive.
It's pretty rare.
Yeah. So that gives them a lot of flexibility, right?
Absolutely, yeah. It means they don't have these big interest payments hanging over their heads. Those can really eat into profits. So this gives them more breathing room financially, lets them invest in things like R&D, pursue expansion opportunities, or even, if the economy takes a downturn, they can weather that storm more effectively.
So low debt-to-equity ratio, generally a good sign.
It's a good sign for a company's financial health, yeah,
Yeah.
and their agility.
Okay, cool. Let's talk about PAT and CFO.
All right, PAT and CFO. So PAT, that's our profit after tax, right? And CFO, that stands for cash flow from operations. And looking at these two together, it's all about understanding how good a company's earnings really are.
Okay, because they're both about money, kind of.
Yeah, exactly. Yeah. But PAT 8 is based on accounting principles, and it can be, sometimes influenced by things that aren't cash or maybe some fancy accounting maneuvers.
Okay.
Whereas CFO, that focuses on the actual cash that's being generated from the company's core business activities.
So it's more like the reality of their situation.
It's a reality check, yeah.
Got it.
Ideally, what you want to see is that PA and CFO, they're moving in the same direction, and they're relatively close in value. If there's a big gap between the two, then, you start to wonder what's going on.
Like what kind of questions?
Well, let's say, for example, a company reports a really high PA, but their CFO is much lower.
Okay.
That might mean that those earnings aren't as sustainable as they look on paper.
Interesting.
Maybe they're using some aggressive accounting practices, or there's a lot of non-cash items that are making their profits look bigger than they really are.
So it's like a magic trick. Looks impressive, but who knows what's going on behind the scenes.
That's a good analogy.
Yeah.
Now, for AMI Organics, in fiscal year 2023, their PA was 83 crore rupees, while their net cash flow was 66 crore rupees. So that gives us a PAT to CFO ratio of about 1.26.
Okay.
So a ratio of 1, that would mean the PA and CFO are totally in sync. So what do you think? 1.26? Cause for concern.
I don't know. What do you think?
It is slightly above 1.
Okay.
It's not a huge red flag, but it's something to keep an eye on, definitely.
Okay.
It suggests there might be some differences between the profits they're reporting and the actual cash they're bringing in.
Duly noted, added to the mental checklist. What about ROCE, ROE, and asset turnover? What can those tell us about AMI Organics?
Okay, great questions. So our OOCE, return on capital employed, this basically measures how efficiently a company is using its capital to generate profits.
So, like, how good they are at business.
Exactly. How savvy are they? AMI Organics had a ROCE of 16% for fiscal year 23, which is, respectable.
Okay, not bad.
Not bad, yeah. Not setting the world on fire, but
Respectable.
respectable. Now, ROE, return on equity, that's looking specifically at the return that's generated on the investments made by shareholders.
Okay, got it.
So it tells us how effectively the company's using the money that its owners have invested. For fiscal year 23, AMI Organics had an ROE of 9.37%, which is lower than their ROCE.
Interesting. So does that mean they're not doing as good of a job rewarding their shareholders?
Not necessarily. Remember, ROE is affected by how much financial leverage a company is using.
Leverage.
Since AMI Organics is virtually debt-free, their ROE is naturally going to be a little bit lower than their ROCE.
Yeah.
It's just a quirk of the math, not necessarily a sign that they're doing poorly.
Okay, so not always a direct comparison.
Right. Context is key when we're analyzing these ratios.
Got it.
Now, asset turnover, that one tells us how effectively a company is using its assets to generate sales.
Okay.
So think of it as a measure of their operational efficiency.
Are they getting the most bang for their buck?
Exactly.
Right. So are they squeezing every last drop out of their assets, or are things a little bit slow?
Well, unfortunately, the specific asset turnover figure isn't given in the info that we have.
Oh, bummer.
Yeah, we'd have to calculate it using some extra financial data.
Too bad. We were on a roll with the ratios.
I know.
But hey, that's a good reminder that there's always more to dig into.
Absolutely. Always more to learn.
Speaking of digging, you also wanted to talk about the pros and cons section.
Yeah, that's right. It's always good to look at both sides of the coin.
Right, the good and the bad.
Exactly. Now, one of the pros, we've already talked about it, is that they're practically debt-free, which is huge. But what about the potential downsides?
Okay, lay it on me. What are the cons we need to watch out for?
Well, one of the cons that's been listed is that high PE ratio that we talked about earlier.
Right, of course.
While it can be a good sign that investors are optimistic, it also comes with the risk that the price could drop if their growth doesn't meet those high expectations.
Okay, yeah, double-edged sword. What else?
Another concern is how cyclical the chemical industry can be. That means their performance can be affected by bigger economic trends, which can make things a little unpredictable.
So things outside their control, like what a global slowdown could impact demand for their products.
Exactly, yeah. And while they have a pretty diverse range of products, which helps to balance things out, it's still something to keep in mind.
Definitely something to keep in mind. Okay, so we've looked at the good, the bad, and the unpredictable. We've crunched numbers, broken down ratios. We've even put on our economist hats for a bit.
Yeah.
So what does all this mean for our listener who's been following along on this deep dive?
Well, it means they have a much clearer picture now of AMI Organics' financial situation. They can weigh those pros and cons, look at those potential risks and rewards, and then decide for themselves if this company fits into their investment strategy.
I like that we're giving our listeners the tools to make their own decisions, not just telling them what to think.
Exactly.
But before we wrap things up, one last question. Given that they have such strong growth, but that high PE ratio is still kind of looming out there, what do you think the future holds for AMI Organics?
Well, that's the million-dollar question, isn't it?
It is.
Their focus on these specialty chemicals, it definitely puts them in a good position. Think personalized medicine, sustainable agriculture, all those mega trends that are driving demand. But they're also going to have to navigate some challenges, right? Like competition,
Right.
Volatile input costs, those regulations that are always changing.
Sounds like a pretty exciting, but maybe bumpy ride ahead.
Could be a wild ride.
So any parting advice for our listener as they keep an eye on Omni Organics and see what happens?
I'd encourage them to really broaden their perspective.
Okay.
Compare Omni Organics to some other companies in that specialty chemicals market. See how their numbers stack up. What are their strategies? It's all about context, right?
Yeah. Benchmarking, as the business folks like to say.
Benchmarking, exactly.
Well, I think we've thoroughly unpacked Omni Organics' Q2 performance. We covered everything from revenue to those ratios, hopefully left our listener feeling informed and maybe even inspired.
Yeah, me too. It's been fun.
And to our listener, thanks for joining us.
Yeah, thanks for listening.
Remember, the world of finance, it's always changing. So the more you know, the better you'll be able to navigate it. Until next time, keep those brands engaged and that curiosity alive. We'll see you then.